You may have heard about a system for paying your house off early called velocity banking.
Velocity banking was popularized with a book by Harj Gill called How to Pay Off Your Home Years Sooner and Retire Debt-Free.
Harj Gill came to one of our infinite banking events shortly after he wrote his book.
We didn't even know who Harj Gill was at the time. We just knew that he had signed up to attend our seminar.
We invited him back to dinner at our home afterwards, and I remember riding on that trip back to our home with him for dinner, and we passed the mental institution in Salem, Oregon. The mental hospital is a big set of buildings on about 100 acres in the middle of Salem, Oregon. And Harj Gill wanted to know, what are these buildings out here? We told him it's the mental hospital. He said, "Really? You have that many loonies here?" He's from Australia.
Over dinner, we got to talking about whole life insurance and HELOCs. And Harj told me if I would have known there was something like whole life insurance, which isn't available in Australia, in fact, it's only available in North America, Canada, and the United States, I would have told people to use whole life insurance instead of a HELOC.
So let's talk about velocity banking, how it works, and how it compares to using whole life insurance and infinite banking.
Velocity banking is a way to accelerate your mortgage payoff, and you use a HELOC to do it. So you have your mortgage. Let's say your mortgage is $100,000, and let's say you also have a home equity line of credit for $25,000 that you haven't tapped into. But you can tap into that HELOC to help pay down your mortgage with a lump sum. For the sake of the example, let's just say that the interest rates are the same on the mortgage and on the HELOC at 5% interest. And this example comes from an article on velocity banking that we have on our website at mcpheeinsurance.com. So we'll put the link in the resources for you. The idea with velocity banking then is that you take from the HELOC and you pay a lump sum down on the mortgage. Then when you make your income at the beginning of your monthly cycle, let's say your income is $4,000 a month, you're going to put that into the HELOC to pay down the HELOC balance. Then you're going to put your expenses on the credit card throughout the month. And at the end of the month, you're going to pull your expenses from the HELOC. Let's say your expenses are $3,000 a month. Well, that's still going to leave $1,000 a month plus the interest you save throughout the month that gets to repay the HELOC balance and keep the interest as low as possible. So you've made progress here. You've saved interest on $4,000 throughout the month, and the HELOC balance is still $1,000 a month lower, plus that interest savings by the time you're at the end of the month. And then you rinse and repeat that cycle. That idea of putting your paycheck into the HELOC and then drawing out your expenses from the HELOC, that idea is called paycheck parking. That's a strategy that velocity banking uses, and it does. It helps you to pay your mortgage off faster. If you do this on a $100,000 mortgage, you should be able to pay the mortgage off in about 6 years and 4 months. What people often don't look at when they're talking about the velocity banking, if you just would have taken the extra $1,000 a month that you had from your cash flow, and you would have accelerated your mortgage payment with that, then your mortgage would have been paid off in 6 years and 5 months, just 1 month longer. But velocity banking does cut a month off of that, and it saves you about $1,450 some of interest.
So there's some assumptions that are being made with velocity banking. And the first assumption is that paying off your mortgage is the primary focus that you should have financially.
That's a big assumption. Is that always the best thing to do?
It could create a liquidity problem. It could create a cash flow problem. And it could also create a situation where you're just adding more debt to debt if you're not careful.
You're basically using debt to fight debt. That can snowball on you if you get on the wrong side of that equation.
The second assumption is that saving interest is always the most important thing. And sometimes that isn't the most important thing. Sometimes living is the most important thing. And if we're putting all of our resources financially into this HELOC velocity banking situation, it could lower our standard of living for those years it takes to pay the house off.
It sure could.
Another assumption is that equity in your home is the same as savings. And people often think, well, I can get to the equity in my home just as easily as I could to savings. So if you're putting all your extra money into the home to pay it off, now you've got equity in the home, but that is not the same thing as savings.
It sounds reasonable on the surface, especially if you have a HELOC. Well, can't you just go and draw from that HELOC again, like you're doing with your paycheck parking every month?
Well, we had a client who found out that that was not the case. Years ago, Betty's husband had some heart issues, and he was in the hospital, developed medical bills. And when he got out, they've got all these medical bills. And Betty said, no problem. My house is paid off. I will go get a HELOC. And so she went to the bank, and the bank said her income didn't qualify for a HELOC. They didn't have the confidence that she could pay the loan back, and she couldn't get money out of her house to pay those medical bills.
Ouch.
So there's some pros and cons that we have to look at about velocity banking. One of the pros is that a HELOC, instead of being a mortgage where interest is amortized over 15 or 30 years, it's simple interest. And that means if you pay the interest, the balance doesn't go up.
Okay, so it doesn't compound against you as long as you're paying the interest every month.
The other one is that it reduces the daily balance. And that's what you were talking about earlier, John, is that, this paycheck parking reduces the balance and therefore, quote, saves you interest. And the third pro about velocity banking is that it accelerates the principal pay down of your mortgage.
And that really goes back to one of those assumptions is that it's really best to pay off your mortgage than do anything else during that time.
That's right.
What happens if we shake this up a little bit and change some of these interest rates that are involved?
That could change the whole picture.
So for your example, you used the mortgage rate and the
HELOC rate exactly at 5%.
Okay, so what if they were different?
If they were different, it changes the picture big time. Now, if they're both different in the same way, let's say the mortgage is at 3% back when we had low interest rates, and the HELOC was at 3%, then it's the same sort of picture.
Sure.
Most of the time, a HELOC rate is going to be an adjustable rate, whereas a mortgage is going to be a fixed rate. And the fixed rate on a mortgage is often going to be lower than the adjustable rate on a HELOC. We often see that. In fact, right now, the average national rate on a mortgage is around 6.7%. The average rate on a HELOC is over 8% right now. If you're using the HELOC to help accelerate paying off the mortgage, it doesn't really make sense to do that if you're borrowing from the HELOC at a higher interest rate to pay off the mortgage at a lower interest rate.
So they may not be paying interest as long because they're going to kill this mortgage, but they're paying higher interest and sacrificing their savings along the way.
Yes.
The whole idea of velocity banking, one of the cons about it is that it takes a lot of discipline to follow through with this. You mess up a little bit and now you're just adding debt to debt. And if you're not a very disciplined person, velocity banking may not work for you very well.
You can get on the wrong side of that debt really quick.
And the final con that we see in velocity banking is what happens if there's another 1982 or 2008 where the value of your home goes way down compared to what you owe on it. And that could cause the bank to call your HELOC, because they're only giving you that HELOC based on the valuation of your house. And if it goes down in market value, they'll pull those HELOCs just like that. And that's historical fact.
That's a risk that you're taking then when you're using a HELOC. That kind of goes back to what we were saying about equity not being the same thing as savings. Even if you have this HELOC and you think you can go and access it, you may not be able to if the bank cuts that line of credit or freezes what you can access in it. So that could throw a real wrench in your plans for velocity banking. Let's say that you've put your $4,000 of income in for the month and you haven't taken your expenses out for the month yet. And the bank goes ahead and freezes your line of credit. Okay, you can't draw anymore out of this. Well, where are you going to get the money to pay for your expenses for the month? Maybe you're going to have to carry some credit card debt for a while. So that's where using debt to fight debt can come back and bite you. And the other area is in the interest rate. Oftentimes, the HELOC interest rate is higher than the mortgage interest rate. And you might think, well, that might be okay if I'm paying simple interest on the HELOC, or I'm only paying interest only. I'm paying it off each month, so it's not compounding, whereas the mortgage is compounding. But the mortgage is compounding simply because it's a bigger balance, that you're not paying all the interest every month on it. If you took a fixed mortgage and you took a HELOC and you paid the full interest amount on both of them every single month, then the accumulation is going to be identical if the original amounts were identical. The interest works the same way. It's just the fact whether it's amortized over a long period of time or whether you're paying it every single month.
And that's if the interest rates on both of them are the same as well.
If the interest rates were both the same and the original amounts were both the same. But for the velocity banking, the balance on the HELOC is usually going to be lower than the balance on the mortgage. The mortgage is still compounding, whereas you're usually paying the interest and a little bit more on the HELOC each month.
And that's where the term velocity comes through, because you're pouring money through that HELOC over and over and over again. So you're velocitizing the balance in the HELOC and bringing it down, then bringing it back up, and it vacillates back and forth. And that's how it can work at all. But you got, like you're saying, the interest rates, you got to watch them, and you got to make sure you stay on top of it.
And of course, with a fixed mortgage, you can't pull money in and out like you can with the HELOC. A little bit different animal from that perspective.
When we get back from the break, we're going to look at an example of velocity banking.
This is the Infinite Banking Made Simple binder. Everything you need to know about infinite banking in one spot. And it's a free download. Answers to the top commonly asked questions like what is infinite banking, how does it work, and how much does it cost to get started are answered right here. You'll find the step-by-step diagram starting on page 7 and the investment comparison on page 8. This Infinite Banking Made Simple binder is a free download. You can click the button to get your copy. At McPhee Insurance, we believe infinite banking has become too complicated and confusing, but it shouldn't be. And that's why we created this binder. Infinite banking is simple when you stick to the essentials and the facts. And the people who put it into practice get results. Don't let insurance terms like modified endowment contract, 7-pay test, direct recognition, and paid-up additions keep you from understanding infinite banking. Download the free binder and see how infinite banking can work for you.
As of August 19th, 2025, the average mortgage interest rate in America is 6.7%. The average HELOC interest rate in America is 8.13. Let's see how that pans out in a velocity banking situation, in a real life situation.
If we take the same velocity banking example we were talking about before the break, where you have the mortgage of $100,000 and you have an additional HELOC of $25,000, this makes the math easy because I know most mortgages are going to be more than $100,000. Well, you can simply multiply by 3 or 4 to get to the mortgage amount that you actually have. You can simply multiply the HELOC the same way to help with the value of the home. But let's talk about two people, twin brothers, if you please. Let's call them Victor and Sam.
The reason we're doing this is because, as you know, twin brothers look alike. And so we want to keep track of which brother is who. So Victor starts with a V. He's practicing velocity banking. And Sam starts with an S. He is going to concentrate on his savings.
He's going to take the full 30 years to go ahead and pay off his mortgage. It's at a 5% interest rate. He's not rushing to get that paid off. But Sam's going to prioritize his savings. And let's say he can earn 4% on his savings. And let's just look at the numbers over the years and see how these two brothers do. Sam he's going to start saving $1,000 a month right away because he's not going to be using that to accelerate his mortgage. Victor, he's going to be accelerating his mortgage, but not all into his mortgage. He's not going to have any extra savings. He figures he can go draw it from the HELOC if he has something come up. So they both do this. At the end of 5 years, Victor has 0 in savings. He's still accelerating his mortgage. Sam already has over $66,000 in savings,
which is more than he saved because of that compounding interest.
That's right. He's earning 4% on that in addition to putting away his $1,000 a month. Now, let's fast forward to the time when Victor gets his mortgage paid off. Because Sam does have a higher mortgage during this time than Victor does, because Victor's accelerating his mortgage payoff faster. 6 years and 5 months, let's say, because that would give an equal comparison. Victor has his mortgage paid off. He actually has it paid off like a month earlier than that.
Okay. So
Okay.
he's been celebrating for a whole month now.
Yep. And he's almost ready to save his first $1,000 because he delayed his savings as he's paying off his mortgage. Sam already has over $86,300 in his savings. Do you know what Sam's mortgage balance is at this point? It's only about $89,000. The exact number, $283 that's left on his mortgage. He could pretty much pay off his mortgage. He just has like an extra $3,000 of interest.
So in
there,
3 months,
accumulation.
if he took that $1,000 right now
Yeah.
that he has been putting towards his savings, he could pay that mortgage off in about 3, maybe 4 months.
That's right.
But he would
he's not
still
in a rush to do
have
that.
he would still have that 89,000 that's been sitting there accumulating all those years.
Sam has
86.
$86,000 of savings. He has a mortgage of 89. So he could take the 86 and go pay off a big chunk of that 89 if he really wants to. But he doesn't really want to. He would rather have the use of his savings over these years and let it keep growing for him. So if let's continue this example out now. Victor starts saving. He doesn't just start saving $1,000 a month. He starts saving the $1,000 a month plus the mortgage payment he was making. So we keep the cash flow similar. So Victor's going to save extra money to start catching up. He's paid off his mortgage. He has the cash flow. He's going to keep his cash flow identical to his twin brother. So 10 years down the road now, Sam has $147,250 in savings. Victor has $72,700 in savings. Yeah, Victor doesn't have a mortgage, but he doesn't have as much in savings yet. We go 20 years out, Victor still doesn't have as much in savings. He has $334,000 in savings. Sam has over $366,000 still yet. You go 25 years out, Sam is still ahead of Victor. It's not until 25 years and 7 months that Victor finally pulls ahead in his savings program.
And this is why Einstein said that compounding interest, is the eighth wonder of the world. At least that's what he's quoted as saying, because the compounding effect that Sam has had here has been going on for a much longer time than what Victor. And so to try to make up that difference, Victor has had to put a lot more money into his savings after his mortgage was paid off, and he still hasn't caught up with his brother, Sam, by 25 years.
25 years is a long time. Sam could use this savings to do a lot of things during that time.
Yes.
And it depends, what he can do, it depends on the interest rate. We set an interest rate of 4% for Sam's savings growth. The mortgage rate was at 5%. So Victor, by paying off his mortgage early, Victor is getting a little bit ahead in the long run, but it takes over 25 years to see the results of that, for him to get much of any benefit, because they're both living in their house during this time. The idea that Victor is pursuing is he knows that if he keeps that mortgage for the full 30 years, he's going to pay over $91,000 in the volume of interest to the bank. He doesn't want to do that. He wants to save that money. Sam sees, on the other hand, that if he doesn't start saving money, he's going to lose a lot of volume of interest due to the compounding he could have had if he accelerates his mortgage like his brother.
So at the end of this 30-year period that Sam has taken to pay his mortgage, how much difference does Sam have in his account that Victor has in his account? What's the difference?
If we look at the net number, once both of the mortgages are paid off, Victor is ahead by about $31,200.
So Victor sacrificed not having to pay $91,000 of interest to someone else to have $30,000 more than his brother.
Right.
That doesn't make sense.
He only recovered about a third of the interest because he lost on the compounding of his savings.
Yeah.
And it depends on where we set the interest rates. If we set the savings rate at 5%, then Sam would be right on even par with Victor. Victor would have given up all that time and the access to his savings basically to be at the same spot after 30 years. And if we say that Sam has an opportunity to earn more than 5% on his money, maybe he has a business that he's running, he could earn 6 or 7% in, then Sam is always going to be ahead of Victor when it comes to cash flow and when it comes to his savings.
Well, Sam and Victor are hypothetical people, but we gave that example for you to see an exact comparison between people that are twins that do different things with their mortgage. But Michelle and I paid off our first mortgage in 5.5 years, and we weren't ahead financially for that. We paid our second house off with cash, and we thought, yes, we're winning. We're not having to pay all that interest, but it still kept us behind the 8 ball financially. You see, it's about what we are able to keep of what we make that changes our lifestyle. And if we're just changing savings for equity, we're not getting ahead, because banks don't really want to look at your equity to give you a loan. They want to see if you have the ability to repay a loan that they create for you. That's why infinite banking made so much sense to us, Michelle, when we first started doing infinite banking. Here was a place where we could save our money that would grow and outpace the interest that we were paying on our mortgage. And when we grasped that idea, we realized that paying off our mortgage wasn't the most important thing in life, because it changed our lifestyle so much. It allowed us to know that our savings in life insurance was going to outperform the interest that we were going to pay on our mortgage. So it freed up our cash flow so that we could do other things with it, enjoy life, and create real wealth, not just money.
It's really important to get your savings started so you can have that momentum built that gives you a cash cushion for things that come up in life, but also allows you to take advantage of opportunities along the way. And when you have a mortgage that you just have a set amount that you have to pay, your house doesn't act any different when you're living in it, but it frees up some of your money to put towards other things, towards savings, towards business opportunities, towards living, like you said.
So what if someone wants to pay off their mortgage sooner than 30 years? They don't want to have the mortgage for the full 30 years, but they want to have the flexibility, the cash flow along the way. They could choose somewhat of an in-between.
They certainly could. That's really what infinite banking is. And if you look at the difference between a 15-year mortgage and a 30-year mortgage, and if the payment different, because the 15-year mortgage is going to have a higher payment regardless of what the interest rate is, and the 30-year mortgage is going to have a lower interest rate typically. So if you look at the difference between those, and there's a $900 difference in those payments on a monthly basis, it would be better off for you to take that $900 and put it in a life insurance policy on your life, so that the cash value in that whole life insurance policy would be what you need to pay off your mortgage in 15 years, because the cash value will be there for you. Not that you have to do that, but it's there as an option for you. And in the meantime, after the first $900 payment, the death benefit on your life will be enough to pay the mortgage off for your spouse.
Just after the very first $900 payment.
That's correct.
That's pretty nice to have a death benefit, that protection built in to go ahead and pay off the house if something does happen.
And of course, over the years, those first 15 years, that money's accumulating, and maybe there's some maintenance issues. Maybe there's some remodeling that most people want to do in their homes in 15 years. That's going to bring the equity value of your house up.
So then you could borrow from the insurance company against your policy, take a policy loan, and do some of those maintenance or remodels, upgrading, and then be paying it back. So then in 15 years, you would still have that money there that you could use to pay off your house. Now, go out 15 years, they may decide they are just happy making their mortgage payment and not want to access the cash value to pay off the house. They have options.
Instead of using the HELOC, that strategy would be using the life insurance policy as your HELOC, only it puts you in control. You know the bank's not going to cut that line of credit. You know the interest rate's not going to be changing drastically on that loan. You have more control over your options.
And unlike a HELOC, the life insurance policy keeps compounding in your favor even though you borrow against it. And so it continues to grow as long as you just pay the interest on it. Whereas a HELOC, the balance just stays the same.
Is it still worthwhile to use this strategy if the interest rates on the 15 and 30-year mortgage are different? So let's say the interest rate on the 15-year mortgage is lower than the interest rate on the 30-year mortgage. So maybe we don't have an interest savings there, but we still have the cash flow. What's the benefit in that case?
Well, if you go just a few years longer and pay, the life insurance policy, maybe 17 or 19 years, you're going to get enough cash value in that policy to go ahead and pay the mortgage off anyway.
Okay.
But that may not even be what
Delays a couple of years, but you still have a cash flow benefit.
that might not even be what you want to do 15, 20 years down the road. It might be that you want to just go ahead and pay your 30-year mortgage because that fits your cash flow on a monthly basis very easy. And if you stop paying the premium, that $900 on your life insurance at 15 years, and just let it sit there, by the time you're 70, you have all the money back you would have paid on your mortgage anyway for 30 years. So how much did your house cost you if you do it that way?
Where velocity banking has its weak points, infinite banking wins with the participating whole life insurance. Velocity banking has you minimize your savings, delay that, so that you can pay off your house faster. The infinite banking concept with whole life insurance lets you increase your savings and keep it under your control, and you have the money that you could pay your house off if you want to, but it gives you control of that money while you don't choose to exercise that option.
And I believe that's what Harge Gill saw over dinner that said, I would have had them use whole life insurance instead of a HELOC.
It makes sense. And of course, that the whole life insurance, that wasn't available in Australia, where he originally wrote his book.
The benefits of using whole life insurance, it allows you to increase your savings. Velocity banking doesn't do that.
It also allows you to maximize your liquidity with whole life insurance. You can access that money by taking a policy loan from the life insurance company. A HELOC could be frozen. So velocity banking doesn't provide that much flexibility.
It also builds a legacy. So now not only will your inheritance have the house that's paid for, it'll also have the death benefit that is greater than what the house payment is. So it's almost doubling your legacy.
Velocity banking, if you're going to accelerate your mortgage all the way, it's going to limit your long-term savings. Think savings for retirement, for your golden years. Infinite banking does not force you to delay that. You can start your savings right now. You can still have access to use the money to pay off your house at some point if you want to do that early, but you're not delaying your long-term savings while you get started with that process.
So if paying off your house early is your primary focus financially in life, velocity banking may work for you, but it's not the best thing for you to do financially.
Velocity banking is a way to manage your cash flow to pay off your mortgage early and save money on the volume of interest you would otherwise pay on that mortgage. But you want to make sure you don't delay your savings while you do this and lose the ability to use your savings during a big part of your life.
Why did Nelson Nash quote Albert Einstein saying, "Imagination is more important than knowledge," when he spoke of infinite banking? Come back next week when we're going to talk about that right here on Wealth Talk.